Hello everyone, my name is Nik Dimov and this is my presentation on accounting fraud, focusing on the Sarbanes-Oxley Act and Repo 105. So what is the accounting role in a business? Well, there are basically two roles. The stewardship role, which is the ethic that embodies responsible planning and management of resources. In this role, the accountant would help a firm's CEO and managers to create budgets and make the company or firm run smoothly, and if there are any issues with the financials, it would help resolve them fast and effectively. The financial advisor role is analyzing business financial data and informing investors of its financial health. An investor will go to the accountant with financial data about a specific firm. The accountant would analyze information and give a feedback to the investor, informing them where the money is coming on from and the financial health of that firm. So why is there accounting fraud? Well, there are three basic elements that lead to accounting fraud. Rationalization is the personal justification of a dishonest act. You're thinking you're doing the right thing for the business or yourself. Perceived pressure, financial or emotional pressure leading towards fraud. Modern firms are expected to have better and better financial data each quarter, and this could lead CEOs or accountants to commit fraud and bump up the numbers to satisfy investors. Perceived opportunity is the ability to execute fraud without being caught or thinking you can get away with it. Some famous cases is Enron. It was a big, powerful company, power company. It used mark-to-market accounting created by Ken Lay and Jeff Skeeling, and this method was used to inflate Enron's assets. Using this method allowed Enron to assign future revenues on current financial statements. Say Enron signed a 10-year deal worth $10 million. It would assign those $10 million on the current financial statements, and even if the deal didn't go through, those $10 million are on the financial statements, helping Enron get more investors. They did this year after year until the people in government caught up to them, and it led to their bankruptcy. The result from the bankruptcy was $74 billion in losses and over 20,000 people were unemployed. There were also a lot of criminal charges, 15 guilty pleas, 6 prosecutions, and 11 acquittals. The other famous case is the Lehman Brothers Investment Bank. They used the Repo 105 to convert over 50 billion in liabilities to assets at the end of each quarter. How the Repo 105 worked was Lehman would sell assets at the end of each quarter in exchange for cash, and instead of financing, it reported these transactions as sales on the balance sheet. This fooled investors into thinking Lehman was in better financial health than it actually was. So Lehman had two branches, Lehman US and Lehman International, which was located in Europe. The Lehman International would sell the assets to other banks and businesses, and they would get a loan with 5% interest. Then the Lehman International would sell that to the Lehman US as a sale. So that's how it looked on the balance sheet. But they had to buy those assets back at the beginning of each quarter with and pay 5% interest. They did this year after year until the liabilities caught up to them, and they were $50 billion, and it was hard for them to cover up. This resulted in Lehman's bankruptcy in 2008, which also started the financial crisis because people went on a bank run and the housing market crashed. So what prevents accounting fraud? Well, after the Enron scandal, the Sarbanes-Oxley Act of 2002 was created. The rules under this act were all documents pertaining to a firm's financial information must be kept for 5 years. An external audit must be hired to review financial statements because he would be unbiased. All financial statements must be signed by firm CEO and external audit. This assigns responsibility to these individuals. Firms must publish information about internal control. And financial statements should include information about transactions and obligations that are off balance sheet. Penalties for breaking these rules are imprisonment for up to 20 years for every violation, and financial penalties from $1 to $5 million. So modern issues that could become troublesome. We have modern firms have a lot of intangible assets and goodwill. Intangible assets are copyrights, patents, research and development projects, and employees fall under this category. Goodwill is the value of a company's name and reputation. For example, Company A was bought for 150 million. Company A has assets worth 120 million and liabilities worth 10 million. So the actual value is 110 million, but it has 40 million in goodwill, so that's why it was sold for 150 million. The intangible assets in goodwill are really hard to put a value on, and this could be an issue in the future. So modern firm versus old firms. Modern firms such as Google have a lot of very little tangible assets, and most of their value comes from intangible assets, which I said before uh, can be hard to evaluate, and accountants could exploit that and commit fraud. Old firms such as Toyota have most of their assets are tangible: cars, factories, robots, and this helps to set an accurate value of the business, and there are a lot of regulations pertaining to old firms. So is that enough? Well, the Sarbanes-Oxley Act is the main law that protects people from financial fraud. There are some issues with it. The act is 13 years old. Firms like Lehman Brothers are finding loopholes, and it's getting harder and harder to prosecute. Goodwill and intangible assets can be hard to evaluate, and this gives creative accountants a loophole for fraud. So, what can be done? Well, the SEC should have more control over these firms, and goodwill should be restricted to a percentage of company's value. So, say 20%. So, if a company is worth $100 million, at 20% goodwill, the goodwill cannot be more than $20 million. And the current value of an intangible asset should be a percentage of future total value. So if a research and development project is valued at $20 million, on the current financial statements, there should be recorded at least $5 million, and the rest of the money should be reported accordingly under the other financial statements in periods over time. So my conclusion, there will always be accounting fraud, but the solution to this problem would be if the government kept up with times and made new laws to protect investors against publicly traded corporations. There needs to be an easy way to put intangibles, to put a value on intangibles and goodwill. And for me, the government should have a program that protects investors' money. In the Enron case, the key executives left with tens of millions of dollars, and all the investors and the workforce were left with nothing. And I don't believe that is fair, and the government should do something about that. This was my project. This is my works cited page. Thank you for watching.